Good morning, everybody. Welcome. Sorry for the small delay. Here we are once again. Live market open for September 21st. It's a big day. It's two big decisions. We had one now at the Bank of Japan, and we'll have another one, the Fed, of course. I'm Yohay, Elam, Forex Crunch and Market Movers podcast, doing the show as usual for FX Street. Again, sorry for the delay. Today we'll cover, recent developments in markets. There were quite a few. We'll start with the BOJ. Various charts and levels, of course, a preview of the Fed, and the currency of the week this week is euro-dollar, and we'll preview, of course, the next week. In any case, your questions are always more than welcome. So if you cannot see the chat box for any reason alongside the screen, please go to the address here, tlk.io/fxread-forex-live-video. Before we start, just a small message from FX Read. FX Read is back with the new edition of Trader of the Year Demo Contest, competition sponsored by Handtech Markets, where you can win Forex prizes with a total value of $16,000 US. For all the information and for signing up, it's until the end of the month. Go to fxread.com/info/contest. Sorry. Okay. What did we have overnight? We had the Bank of Japan. The Bank of Japan. Good morning, Ramon. Good morning, everybody. Sorry for the delay once again. The Bank of Japan decided to change things. What exactly did they do? Well, they will focus for now on the yield curve. They want a steeper yield curve. They want the trend to be to the upside. And they let go of some other measures. Now, they want to buy something like 80 trillion yen of bonds a year, but it's not that strict anymore. They didn't change the rates. They did say that they'll buy more TOPIX. TOPIX is one of the indices, stock market indices in Japan, and that helped stock markets. And they said that they'll allow inflation to reach above 2%. Of course, inflation is closer to zero. They did declare victory on deflation. On the other hand, with inflation, they said they'll let it run. Basically, they sort of changed the focus from telling us exactly what they will do to what their targets are. So they want the 10-year interest rate, the 10-year yields to be around zero, and that's a change in focus. Now, why do we see positive reaction from dollar yen? That means the weaker yen, which is not that common with Bank of Japan decisions. Remember, during the past year, the BOJ got for them quite well. All these, let's look at the charts. So, okay, we're already going back down. So this year, when they set negative interest rates early in the year, the yen got stronger eventually. When they added more QE, when they changed ETFs, this time the reaction is more positive for a few reasons. First of all, they're buying of TOPIX, so this is good for stocks, and there's a good correlation between dollar yen and stocks. And secondly, they are they did not lower the interest rates further, and that's actually good because they're already negative, and the banks were complaining quite a lot, so banks certainly like it. Also, bank stocks are up, and that's also good for dollar yen. In general, monetary policy, they took bold steps. They're not so rigid, not so orthodox like other central banks. Again, so far this sort of surprised markets, but anyway, another thing that's good for markets is that they let inflation rise above 2%. They let it settle above this level before tightening back monetary policy. Of course, this is very forward guidance. This is not because inflation is not that strong, and Japan has a demographics problem. I mean, the inflation population is shrinking, so how can prices rise? Many people say. Anyway, we rose up to 102.78 on dollar yen, above support here at 101. We did not reach resistance at 103.43, and now we're already sliding back down. As we speak, BOJ Governor Ariko Kuroda still speaking. Anyway, they did, before this meeting, we talked about that they were going to do an assessment about their QE policy, and their conclusion was that it's all good. But now they made some changes to make it more flexible. So they tell us, don't focus on the means, don't focus on what we do, we'll focus on the result. A steeper yield curve to encourage lending in the short term, but not to depress long-term interest rates in such a severe way to keep them negative. Okay, so that's where we are. So that's the Bank of Japan's decision. Of course, there's tension towards the Federal Reserve. Okay, so the Federal Reserve, of course, is meeting tonight. We'll have a full preview for that. Towards the event, we've seen in general last week especially, and also a bit of this week we had a retreat. US dollar did strengthen. It's a theme I'm going to repeat several times today. The US dollar, the Federal Reserve, they remain the cleanest shirt in a dirty pile, okay? That means even if the Fed is moving very, very slowly, they're not expected to raise rates tonight, this evening here in Europe. They are still on a tightening path, and that's very different from other central banks, okay? Another thing to watch out for is oil. Hopes for action keep it from falling further. There's a meeting early next week in Algiers to discuss between OPEC and maybe some non-OPEC members to discuss some kind of oil freeze production, or maybe a cut in production, or maybe just stabilizing the market, whatever that means. In the past, they haven't been able to reach any agreement. I think that all this talk is just keeping oil prices floating despite a glut in oil, so oil prices are lower. Remember, when oil prices are lower, the dollar is stronger. That's why I'm talking so much about oil. I believe that after this meeting, it'll probably reach some kind of meaningless statement, not a total failure perhaps, but not oil prices can fall. But remember, when oil prices fall, production in the US also falls, and then it stabilizes. But anyway, I think there's more downside pressure on oil. The Bank of England last week, it was Thursday, it seems that long ago, they left the door open for rate cut in November. This kept the pressure on the pound, but that's not the only reason why we're seeing the pound fall. Okay, let's talk a bit about that, because that's also something focusing so much on the Fed, but also we have this big event. I mean, big moves in the pound. Pound fell a lot. It's not only the Bank of England that, despite the better data, left the door open for November. It's also the summer is over. Now there is already talk about Brexit. What shape will it take? And it seems like the Brexiteers, at least now, at least in the noises coming out of Westminster, they have the upper hand. So they're ready to, in order to get the immigration limits, they're ready to they're ready to let go of the single market. And that's bad news. A hard Brexit, less trade. We've seen the pound lose 130. Of course, it's also related to the US dollar strength. And so that's another thing that moves markets. Another thing, sort of the big news that's going on at the moment is, US elections. The race is a dead heat. If you look at all those poll aggregates, they give Hillary Clinton a very, very, very narrow chance of winning. So she had a bad weekend, making some comments about Trump's voters and then falling sick and not fully reporting about it. And Trump said lots of stupid things, but not less than usual. Anyway, the race is dead heat, and I think markets already begin focusing. This also helps the US dollar. But the big event is on Monday. It's the presidential debate on September 26th. I also wrote here about the S&P. It made for me, it's another, tells me once again, stay away from this currency pair. Okay. Any questions? Of course, questions are always welcome. With more some data, not only the big news. So we had lots of figures from the UK last week. They weren't as great as for July. I mean, the post-Brexit figures were really surprisingly strong. So in August, they were okay. I mean, employment was a small miss, a loss of 2,400 jobs. I mean, a drop in the number of unemployed, 2,400. It's still good. It's still less people out of work, but not as good as expected. Retail sales, better than expected. They did fall 0.2, but that came on top of an upwards revision, and also it came out better than expected. If we move from the UK to the US, things are looking worse. And that also leads us to later the Fed decision. Data is just not good enough. Retail sales in the US fell 0.3%. Also, the control group dropped. It doesn't look good. Inflation did climb to 2.3 on the core figure. Wasn't good enough. I mean, we've already been there before. We're not seeing any kind of acceleration. Consumer confidence remained unchanged, 89, just under 90, also a bit under expectations. Yesterday's building data. All in all, everything looks mediocre. Industrial output, for example, fell. All in all, figures are not a disaster, not a recession, but not looking strong enough. Growth forecasts are all the time downgraded. Moving to the South Pacific, GDP New Zealand missed, well, quarter over quarter 0.9, but beat year over year with 3.6. All in all, the New Zealand economy and the New Zealand dollar sort of stand out among commodity currencies. The Kiwi is the strongest, the Aussie is the weakest, the Canadian dollar is somewhere in the middle. Australian jobs missed with the drop of 3.9 jobs, but the internal figures were slightly better with more full-time jobs than expected. Okay. Now, we'll move to the charts. Let's examine the charts and technical levels starting from the top, starting from euro dollar. Euro dollar did grind to the downside. Okay, we'll have a special focus on that currency, but in general, we're moving down. Support is now at 111.20. Okay, that's a line we've seen, well, right now, but not only now. Zoom out just a bit. We can see that we've been in this line before, so it now works as a double bottom. Resistance there at 113.70, high resistance 114.30, and 116.16. Lower support at getting closer to 110. Pound dollar. We talked about the fall in pound dollar. Let's look at the charts here. So I would say we can even paint here some kind of head and shoulders pattern. Levels to watch from the bottom. No, let's start from the top. 134, the level we've seen not that long ago. That's something to watch out for. We're looking currently at the 4-hour chart. We did fall to lower ground, moving down 133.50. Was sort of an attempt to move higher that was rejected. From there we fell. 132.80 is weak resistance. Looking lower, 131.40 was a swing low and also worked in the past. And 130.65, not that strong, but still worth mentioning. 130 is not such a strong line. It's a very round number, but not a strong line. Strong support here at 129.50, followed by 128.40 and 790. All in all, the trend here is to the downside, a mix of hard Brexit worries plus USD strength. Dollar yen that we already talked about before, well, now it's retreating back to range. It's still higher on the day. So the Bank of Japan still has its impact. Support at 101. We did dip a bit below that line. No, exactly 101. Resistance 103.43. It's a wide range. Dollar yen is moving relatively fast. It's not the boring currency pair it used to be. High resistance 104.15. And 105 is the round level. We find 99.50. And I think markets are still digesting what the Bank of Japan did. Basically did not add stimulus, sort of made itself free to do whatever it pleases, targeting a steeper yield curve. Okay, let's move to dollar CAD. Very strong resistance here at 132.40. Easy to see that here. Support at 131.40. Very much entrenched in range. Moving also by oil prices, but not only that. Further support 130.80 and 130, which, contrary to pound dollar, here 130 is a strong line of support. Next lines are 129.10 and 128.30. To the upside, I would mention 133.15, 460. Aussie dollar currently at 75.80, struggling. old line of 75.30 continues working. It's followed by 75 with the round number, which is a bit weaker. Further to the downside, 74.40. Moving up, we have 76.40 and 76.60, and further above 77.40 and 77.85. All in all, ranges in the Aussie dollar are more narrow. The trend for me remains to the downside, mostly because of fundamentals, but it seems the pair sort of struggles to rise. Kiwi dollar, this is a stronger currency. It was hit. It did have its time in the sun, almost reaching 75. Didn't break higher. Did fall back to range, but in my opinion remains strong. 73.20 is the current level. 73.60 is some kind of resistance, followed by 74.10. And high resistance, of course, 75. If we do get a strong Fed decision today and we have a fall here, 72.40, 72, and 71.60 are lines to watch. Dollar Swiss, not my favorite currency pair, currently shattering the line of 98. Further resistance 98.50 and 99. Support at 97 and at 96.40. Which remains a reliable line. 95.50 is further support. Remember, the Swiss National Bank intervenes. It intervenes mostly in Euro Swiss. Well, it is falling down, but well within the range. The 108 and 109 handles characterize the trading of this pair. Note that in the past month or so, the range was, well, about 120 pips on this cross. I would expect 107.60 to be the line in the sand for this, and be in case we have clear deterioration, but they usually intervene quietly and just keep the pair, keep this cross bid more quietly and don't wait for it to fall. Euro pound, as you can see, moved to the upside, mostly the fall of the pound, not the strength of the euro. So resistance at 86.50, further resistance 87.20, 85 is support, followed by 84.20 and 83.50 on the downside, followed by 83.20. I think the pound is now the weaker link, contrary to what I thought last week before the Bank of England's decision. The pound looks strong on good data, but now with all the talk of hard Brexit across the board, Euro yen 113.60 at the moment doesn't move too much. 115.80 is a line of resistance. Well, not so much. I would say in any case 112.80 is strong support, and this cross doesn't have a lot of direction. This cross has much more direction, and the direction is down. So we had some wobbles now because of the Bank of Japan, but we can see the clear movements of the pound here. 133.20, one of the initial post-Brexit levels, is resistance, followed by 134.40 and 137.10. On the downside, we have 31. Okay, and crude oil at the moment is recovering, with moving up nicely with stocks, but as you can see, the trend is to the downside. We had in August a wide range between $39 to $49. Currently, we're bang in the middle of this range, well, or a bit above, just around 45. This commodity likes to hug the 45 level. 43 is the line of support. Well, the bigger range is 39 to 49. Okay, so that's our technical segment. I see no questions at the moment. Okay, so that concludes the segment. Let's ahead and then focus on the big events. So today is a very, very light day in terms of during the European session. We had the Bank of Japan very early in the morning, and at 6 GMT we have the Fed. In between we have oil inventories. Again, we see a correlation between oil and the dollar. It will be less meaningful because the Fed takes center stage. The Fed releases also forecasts. We'll focus on that, and we have the press conference at 6:30 GMT. Another rate decision awaits us in New Zealand. They're not expected to change rates. They released their decision at 9 p.m. GMT, but they're probably going to talk down the Kiwi dollar. The RBNZ does not like a strong currency. Okay, tomorrow it's going to be Fed hangover. We'll probably have the full reaction to the Fed, which we'll preview very soon. And then at 12:30 we'll have jobless claims, as usual every week. A speech by Draghi, president of the ECB, although last week he didn't say too much, and existing home sales at 2 GMT. On Friday, early in the morning, we have the PMIs from Europe and Canadian retail sales and CPI. It's the big focus is the Fed. It's the reason for the tension so far, and we're going to have a big aftermath for that. So now the focus on the Fed. Here's $1 US, one Janet Yellen, and the Federal Reserve building. Okay, why is it such an important decision? Why did I make this special slide for you? Well, first of all, the Fed this time, well, it has 8 meetings a year, but 4 are more important. This is one of the more important ones. Why? Because it consists of fresh forecasts and a press release. It's been talked about for months if you're following financial press, Forex Crunch, FX Street, and well, of course, other sites like Bloomberg, Reuters, and you name it, everybody's talking about that. For a change, there's not a full consensus, okay? 2 primary dealers do see a rate hike, which is quite unusual. Usually there's only one or full consensus that the Fed will not hike. That's BNP Paribas, a French bank, and Barclays, British bank. Both are foreign banks, I mean, for the United States. But it's weird to have 2 banks saying that the Fed will raise rates. And it's also important because other central banks are also waiting to hear from Yellen and her colleagues. So it's the ECB, it's the Bank of Japan, maybe looking to see what Yellen will do. Before we'll continue, I'll just mention once again the demo contest. FX Street is back once again with the new edition of Trader of the Year, sponsored by Hantec Markets, and you can win a total of $16.5 thousand US. Just go to fxstreet.com/info/contest. Let's continue. We explained why the event is big, and now let's talk about why we will not see a rate hike. Okay. First of all, the political reason: elections are coming. Donald Trump said he's a low-interest guy man, and he wants to replace Yellen. Yellen and her colleagues do not want to be the center of Trump's attention. But also for Clinton, it's bad. A rate hike now could hit the stock market before the election, and she's sort of the incumbent, running on a 3rd term of Barack Obama. In addition, the Fed is dovish. So if they're in doubt, they stay out. Dovish, not all, but most of them, including the last chance to express some data that was from Lael Brainard, a permanent voting member on the Board of Governors, and she was very dovish. The 3rd reason is just data. Low growth, 3/4 of low growth, Q4 2015 and the first half of 2016. Wages, after moving higher, they're once again in retreat, 2.4% year over year. Retail sales were poor. Services sector outlook, according to the ISM non-manufacturing PMI, was poor. And all these figures outweigh the solid job gains. And of course, inflation is just not going anywhere fast. So that's the short version. Of course, we're following the data for a long time. Everything leads to a conclusion not to raise rates. I mean, especially with the dovish Fed. The initial focus, assuming, of course, we do not have a rate hike today, we'll watch the dot plot. The dot plot looks like this. It's a measure of what various Fed members think the interest rate will be at the end of this year, the next year, in 2018, and of course the longer term. I think this time also have a forecast for 2019. In any case, the initial focus will be on 2016. This year, the last dot plot showed a chance sort of 2 rate hikes this year, downgraded from 4 back in December last year. Anyway, I assume most market participants assume that it'll be downgraded to 1 hike this year. That means not in November, because there is no fresh forecast and no press conference, but in December, also after the elections. That's sort of the mainstream view. Okay, if the dot plot will be downgraded to no hikes this year, that will be very, very dovish, very bearish for the US dollar. So that's the initial focus. It's released alongside this statement. Well, before the statement, I'll mention the forecasts. So the Fed forecast will probably acknowledge reality: lower inflation, lower growth, and stable employment. These forecasts I think, will change only just a bit, and will not tell us something we do not know. Downgrade forecasts. This time the downgrades, I think, will not be huge, but still meaningful. And the outlook until 2019 could be interesting, and probably too optimistic, not reflect. Again, the Fed tends to downgrade its forecasts. Now, the statement, of course, we have the statement every meeting, not only this one, not only 4 times a year, but 8 times a year. Nevertheless, it's of course still important. The positive things, on one hand, the glass half full, is that they'll be happy with employment and happy with international developments. Brexit is not a disaster. China's stabilizing its growth. And of course, the US economy is gaining jobs. But the bigger questions are inflation. Is it still stable? When the Fed talks about long-term inflation, it remains optimistic. Everything is okay, even though in the short term it's weaker. If they express worries about inflation, if they're not certain about the inflation outlook, this could be bearish. And what about growth? Is it the same as inflation? Are they worried about growth or still see a better second half? Again, we have the Atlanta and New York Fed GDP nowcasts, and they began the Q3 with 3.6% growth hopes, and now it's down to 2.9, if I'm not mistaken. Anyway, let's see if they're also worried about growth. Well, we'll have one dissenter, Esther George. She already expressed her desire to raise rates. She's dissented in the past quite a few times to the hawkish side. That will not be a surprise. Statement. And then the Fed, Yellen speaks half an hour later. We'll have only 30 minutes to react to the dot plot and statement. And Yellen, apart from her first press conference, is very boring. Yeah, she does not want to rock the boat. She does not want to say something that will be interpreted by markets in a way she doesn't want to. She uses a lot on one hand. On the other hand, the press initially reads a statement, then answers questions. She's not special in this thing. Also, other central bankers, especially American central bankers, just try to keep you asleep. Anyway, it's going to last over an hour. So I think we will see movements during her press conference, but they will not be related to her speech, but rather to responses to the Fed decision. Okay, we'll begin hearing from John Hilsenrath of the Wall Street Journal, a prominent Fed watcher, Bill Gross, previously from PIMCO, now Janus Capital, and other pundits across the financial press. They will begin shaping the narrative. They will begin telling us if the Fed was dovish. These things are, of course, unclear. It might be clear, of course. And things will begin taking shape. Then we'll see some reactions. It will probably not be related to what Yellen says. Of course, Yellen can always surprise. Again, I think the message will be not now because data is not that strong, but we're definitely going to raise rates in December. Anyway, we're going to see the first immediate reaction, of course, when things come out today at 6 GMT and 6:30. Another reaction when Tokyo opens. And the final verdict, the full narrative, will take shape in the European Open, this time tomorrow morning. Conclusion, to wrap up this Fed preview, open door to December is the key for the US dollar reaction, and it should be slightly positive, okay? A closed door, if they remove the chance of rate hike this year, the dollar will plunge. Watch out for the general tone, optimism vs pessimism. If we do have a surprising rate hike today, it'll, despite uncertainty, it'll be still a huge surprise, and the dollar will rise across the board. Okay, remember that in the more mainstream case, that we do not have a rate hike, and that they still open the door for December hike. That is dollar positive, because the US dollar is the cleanest shirt in the dirty pile. Okay, so that's the Fed preview. Let's see if there are any questions. Yeah, thank you, Adinda, for more information about the contest. Well, I don't see any questions, so that's the Fed preview for now. Let's continue to the special focus of this week, the euro dollar. Euro dollar is the currency of the week. Why? It's stuck in range for a long time. I've been expressing my frustration. I'm not the only one. And I would say euro dollar is the new dollar yen. What do I mean? Dollar yen for extremely long periods has been stuck in narrow ranges and then had these crazy spikes. Okay. Since then, dollar yen is moving quite a bit, up, down, for over 2 years now. And usually after long periods of range trading, we have an explosion. When will this explosion come? I don't know, but I think it'll come relatively soon. We have a situation where the ECB, the European Central Bank, is still ready to add more stimulus. Even if it's not bombastic, they will continue their QE program. They will make it looser. And the Fed is still tightening. Again, it's not the same monetary policy convergence we've seen in 2015 when the ECB made its big announcements and the Fed eventually raised rates. Things are moving at a much slower pace now, but the direction is clear. Okay? And this speculation, this monetary policy divergence is different. I mean, it contrasts the fact that euro dollar is naturally bid. If you look at trade balance, the Eurozone has a surplus thanks to German exports, and the US has a deficit. So all things equal, all other things, if we don't have any other movements, if we don't have speculation, euro dollar should go up. But of course, speculation rules the world. And monetary policy divergence can return. The US dollar is also reasserting itself as a safe haven. This is especially true with the US elections. If Donald Trump has higher chances of getting elected, of course, safe haven, but the US dollar is second. The euro was a safe haven back in 2015, but that is gone. Okay, so also so it's monetary policy divergence and the safe haven roles. These, I think, outweigh the fact that euro dollar is natural bid. So my tendency is to see a fall in euro dollar to the downside. Of course, down but not out. I would say 108.20 and 107.10 are big targets. Parity seems a long way. Again, without pressure, with boring markets, euro dollar can rise. Let's look now at a few levels on euro dollar to also give some technical spice to what I'm talking about. So the immediate levels to watch on euro dollar are, well, 111.20. As you can see, it's a double bottom. If it does really go to the downside, the next significant line of support is 109.60. We've been there in the recent past. That's a line tackled a few times, but eventually the pair bounced. More to the downside, we have the post-Brexit low of 109.10. Further, the line I mentioned, 108.20, worked as support back in March when the ECB did a lot, but told us that they're stopping for now. Further support is at 107 back at the end of 2015, the previous ECB mess, and when the Fed raised rates. If we go even lower, it's 105.20 from December and 60, the 13-year low for the pair. To the upside, 113.17 is a line we've seen and works as resistance, followed by 114.30, the pre-Brexit high, and then 116.16, which was the high of 2016. Okay, so that's where I see euro dollar. I think it's ready to explode. My bias is to the downside. Let's see what happens. All right. And let's continue to the next segment, which is, as usual, we do a preview for next week's events. So this is a preview for the week of September 26th to September 30th. Of course, the aftermath of the Fed, some weekend reading will still have an impact. But on Monday, we have the German IFO Business Climate, Germany's #1 think tank. It surprised with the downside fall last time. Let's see what it does this time. From the United States, long-term investment eyed by the Fed. Also, new home sales are important because there's a correlation between housing and the general economic activity. Final UK GDP, it's for Q2, pre-Brexit, and also another measure of US consumer confidence from the conference board. On Wednesday, we have German unemployment, of course, which was generally good. Oil data as usual. And then we have another focus again on euro dollar, which is important next week with the US final GDP and also German and Spanish CPIs as a warm-up for Friday when we have inflation figures from Europe. We also have Chinese PMIs even before the end of the month and Canadian GDP. Once again, Friday's close is more about Canada than in the US. Of course, the following week already features the non-farm payrolls, which is 100% made in the USA. Okay, so that's the preview for next week's events. I would say focus on euro-dollar figures, that US GDP, durable goods orders, and housing, and in Europe, inflation. Mostly inflation and the IFO figures. So euro-dollar isn't focused next week, but quite a mix of other events as well. Final GDP from the UK as well. Okay. So, covered everything. Let's take another look at dollar yen. Oh, it's already reversing everything. So the thrill is gone, I guess. The Bank of Japan took a different path. It worked differently for a while. Dollar yen did go up, but now it's falling back down. Not much over there. Let's see if I have other reactions to the BOJ. No, not immediately. But anyway, I'll mention this is the headline. Okay, let's do the wrap up for today. So the wrap up for Live Market Open for Wednesday, September 21st. The big event of the morning is the Bank of Japan. During the show, we've seen quite a turnaround, okay? We've seen the Bank of Japan deciding to change its focus of monetary policy on results, wanting a steeper yield curve on self-inflicted rules about buying bonds, and will allow for higher inflation. Everything is a bit sort of free, focus on the yield curve and let inflation roll. Of course, inflation is too low. And the initial reaction was a weaker Japanese yen, with dollar yen rising to 102. Now falling 100 pips to the downside from the peak, basically unchanged on the day. Support 101, resistance 103.40. The Bank of Japan is relatively always sort of leading the pack in terms of innovative monetary policy. Is the Federal Reserve. In short, no change. The focus will be on the dot plot. If they leave the door open for more hikes, that means a hike in December, one more hike this year. I believe the dollar will move a bit to the upside, even though it's mostly priced in. If they rule this out, the dollar will fall. Watch out for the tone in general, more optimistic or more pessimistic. The narrative will make a big difference. mean what people say that the Fed said, and not necessarily what Yellen said. Oil is a bit leaning to the downside, not going anywhere fast. We've seen a big plunge in the pound because, well, the door is open to a rate cut in November, and also because a hard Brexit is now on the cards. US elections add to sort of the mixed mood. The race is dead heat. The event, of course, all eyes are now on the Fed, but on Monday we have the debate, the first debate between Clinton and Trump. Okay, let's look a bit at the charts in this wrap up before we head off. So we talked about dollar yen leaning to the, well, back, mean reversion after the big rise. Euro dollar remains very, very stable in range. Support 111.20, 113.70. Pound dollar under 130. Support here at 129.30 and 130.65 is resistance. Dollar yen will be interesting to watch throughout the day. Dollar CAD, very nice range here between 131.40 and 132.40. A lot depends on the Fed. Well, for all currencies, a lot depends on the Fed. 76 is the level to watch on Aussie dollar. Support 75.30. Some recovery there. Kiwi dollar has usually been the stronger currency. The range is 72.40 to 60. All in all, just to show you the election map in the United States, 56% chance for Clinton, and that's basically tied. Rate hike chances, well, 88% against a rate hike, according to bond markets. Again, two primary dealers do see a chance of a rate hike, okay? All right, so I see no further questions here. Again, once again, sorry for the late start. We had some technical issues, but I'm glad we could make it. You can watch, in any case, a full rerun of the show and all the special segments we did, including the Fed preview, Euro-dollar forecast on FX Street relatively soon, and afterwards on Forex Crunch. Thank you very much for those coming despite the delay. It's a very, very exciting day in markets. I wish everybody is safe and successful. Follow the live coverage of the event. And also don't forget about the FX Street the contest. You can win some nice prizes there. And that's it for today. So thank you, everybody. Sorry again for the delay. And see you soon.